Well, in the thick of earnings season, right? I'm going to ask my producer to show you the intraday chart of Tata Metallics. Under pressure, losing its sheen, down by about 5% in trade. For the year, this stock is down by about 20%. The earnings report card is out for the quarter gone by, and you are seeing a massive drop in the bottom line. 1.22 crores for the June quarter, mainly on account of higher expenses. Exactly a year ago, the net profit was about 95 crore rupees. It's a big iron or business which is done very badly. But let's get more details from Mr. Sandeep Kumar, the managing director, who's now joining us live. Good morning, Mr. Kumar. Let's begin with the earnings, right? That massive drop that we've seen in net profit, the pressure that is there on margins. While the ductile pipe business has still done, ductile iron pipe business has still done well, the pressure seems to be coming in from the pig business. The rising raw material costs, the impact it's had on your P&L. Is the worst behind for the company?
Good morning. Thank you for the call. I think your last statement summarized it very well. So yes, I think it was the worst quarter for us in the last several years. And I think fundamentally there were two or three factors. One is the government's export duty on pig iron and steel. 15% meant for us roughly about 10,000 rupees per ton. And between 22nd of May and June, if we sold about 40,000 tons, that means 40 crores out straight away from the EBITDA. So that's one. Secondly, we had all our shutdowns in quarter one. That's how it was planned, and that meant another maybe 30 crores odd. So we had impact of about almost 70 crores, which is a one-off thing, which wouldn't normally have happened. And if you look at the coal prices, the coal prices jumped almost 170% compared to the previous quarter. So it's been a massive hit all through for the industry, and for us in particular because of the shutdown, but more so also because of the export duty cut. So I think it's a pretty bad thing, and we take it on our chest and move on. And I'm sure things will be much better as we move on.
So, Mr. Kumar, is another way of looking at it is that has your business done this badly in the quarter under review, and you are by your own admission one of the worst in history for you because of the higher raw material costs and shutdowns of plants? Or is it also because you were executing orders that maybe have which had been placed before the Russian-Ukrainian war, before that super cycle of commodities?
No, so there were two. We have two businesses. The pig iron business got impacted because of the export duty, and that's where I said about a hit of about almost 10,000 rupees per ton in our realization. Okay, that's what I was mentioning. The other one, what you are referring to, is the ductile iron pipe business, which has been actually moving up. The realizations have been moving up quarter on quarter for the last one year or more. But still, it's not at the same level where actually our booking prices are. Let's say our booking prices are over 80,000 rupees per ton. But what we are executing is much lower because we have old orders. But that's okay. That gets evened out over a period of time. So I'm not so worried about the impact of that in quarter one. But essentially, it was the pig iron business which got hit, and because of the export duty, and of course also the fact that the raw materials were at an all-time high. If I just give you a figure, the coal prices, which were, let's say, about a year back, at $100 per ton, prime hard coking coal, $110, reached a figure of $670 in the month of March. And coming down now, of course, if you look at July, they've come down to as much as $240. So this kind of a volatility nobody has ever seen. And I don't think anybody can manage this. Your prices go from 100 to 670 and comes down to 240. So that's what has really virtually killed us, if I can use the term, for quarter one. But I think as prices have stabilized now, the pig iron prices are also nudging up. The coal prices are softening, and that will improve our spreads going forward. And DI pipe business, of course, is smooth. With the new plant also commissioned, we'll have increased volumes, but mostly in H2. So we are looking at much more positive, behavior of the business going forward.
Fair enough. Good morning, Mr. Kumar, and I wanted to understand what the outlook is when it comes to, in general, your view on your order book at hand currently, given the fact that you've talked about things improving on DI in the second half, in terms of the order book at hand. What kind of numbers or what kind of growth are you targeting when it comes to the overall order book?
So with the new plant commission, we will have, let's say a higher volume. The higher volume from, let's say from the new plant would be only, let's say to the extent of 50 to 60,000 or maybe 70,000 tons in this year, because most of it will come in the second half. The commissioning has been done, but obviously it takes time to ramp up. And it's only the first phase of the plant. The second phase of the plant will come in next year. So let's say if we did about 230, 240 last year, we should be able to do another 50, 60, 70,000 more this year. That's the likelihood. Also, there is another factor on the pricing and on the slowdown of, let's say, executable orders. So even though we had orders, but what has happened is because the prices of ductile iron pipe moved up by almost 60, 70% in the last 1 year, the EPC contractors and the government were at a huge pressure to execute these at old prices because the project costs were getting, exceeded. So there was a slowdown of executable orders also. But I think, and ministry has had a couple of meetings with all of us, and I think now with things coming back, stabilizing somewhat, we would see much better, numbers going forward, especially in H2. I think quarter 2 is a seasonally weak quarter, so we don't expect a massive change here in quarter 2, although it will be an improvement in quarter 1. But H2 will where you will see the significant jump, both in volumes as well as in profitability.
I know you've flagged off the overall profitability and the concerns on that front, but if I were to ask you, Mr. Kumar, specifically when it comes to margins, because the rise in raw material costs have definitely dented the overall margins, given that they have now dropped significantly, as you also alluded to, the fact that pig iron market has stabilized, does this mean that the worst of your margin contraction is now behind us?
Absolutely. So if you look at the spreads between pig iron and, let's say, coke, last quarter was virtually negative. You've never seen coke prices being higher than pig iron prices on a sustained basis in any quarter over the last many years. You hardly ever see that. So that was the case. So that's why I said quarter 1 has been absolutely, an outlier. And we would have been steady had it not been for the export duty. If the export duty, because that compressed our pig iron prices by almost 10,000 rupees suddenly. So otherwise, we would have been up by almost 60, 70 crores additional EBITDA if that hadn't happened and if we hadn't taken the shutdowns. So I think the worst is behind us, definitely. And you will see much more positive numbers going forward. And we are very confident of that.
Mr. Kumar, point taken that Q1 has been washed out and you said Q2 will be more of the same, but from H2 onwards we'll start seeing improvement. But you talked about the export duty impacting your numbers and the fact that you have had several representations with the government as well. What's your take regarding this export duty? Because there were reports in the interim talking about some sort of rollback. Were you part of those representations? Is there any possibility that might be on the cards?
Well, we haven't been making any representation. I think the government, in its wisdom, has put the export duty, and I think in its wisdom, it should consider rolling it back because you can see it's very evident from our results that we're really not making money with this. When you stop exports, and exports all of this volume comes into the domestic market, and it creates a problem for all of us. So I think for the industry as well. Because what also happens is that the buyers and the customers, what they start doing is they start waiting. The sentiment goes negative and they stop the stocking up. So the demand gets impacted. So I think leaving it to the market forces is the best way. Yes, there will be some aberrations like it happened after the Ukraine war. So it was an aberration in the month of March and April and partly in May. But things do stabilize on their own. Nobody can make supernormal profits for long. But by intervening, I think what happens is you create those artificial, constraints for the marketplace. So in my opinion, I think rolling back the export duty is always better in the long term. In the short term, the government in its wisdom has done it. And I'm sure they must be looking at it.
Mr. Kumar, but that's a question which is outside your and my hand, right? Whether that happens or not. Let's take the view that it's likely to stay. if it does happen, what is the recourse that you have to manage demand? Because as you pointed out, the domestic market would not be able to absorb all the supply.
No, so what has happened is that, internationally also, if you look at the pig iron exports, roughly 12 to 13 million tons of pig iron exports happen, this, the trade, international trade, out of which almost 50% comes from Russia and Ukraine. That got wiped out. With the result, the pig iron prices, let's say in US, and these are mostly destined for US and Europe, they moved up from almost about $550, $600 to $900 plus. That has come back now to about above 600, let's say 650 or so. So it's come back to normal levels. The raw material prices have also softened and are coming back to normal levels. So in any case, the market finds its equilibrium, and it is finding its equilibrium now. So irrespective of whether you remove those export duties or not, I'm sure that things will stabilize, and they are looking towards stabilizing. But what happens is when you put an export duty suddenly, without warning, the buyers tend to, the sentiment changes and people stop buying. So the demand also gets hit. So that is where the concern was. So I think now things should get better, irrespective of whether the export duty goes down, up, or whatever. I'm sure the government, in its wisdom, will review it at some stage, but I don't know when.
On that optimistic note, we will let you go, and all the best for the coming quarters, because it does look like there's a lot of upside from the current levels as well. Thank you so much for joining us.